Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Nathan Jameson. He is the founder and managing partner at ARX Capital. It's a real estate investment firm managing over $150 million in assets across manufactured housing, RV parks, and other alternative real estate sectors. He helped scale a national home builder from $30 million to $160 million in annual sales, growing closings from under 100 to more than 400 homes annually. Nathan, I'm looking forward to hearing all about your company, ARX Capital, and about your story. Thanks for being a guest.
Keith, thanks for having me on. I should have mentioned in our little preamble before we hit record, it's actually ARX Capital, but we get ARX all the time. So no worries there. But ARX is actually Latin for fortress. And it's an important part of my story is I was going through a time about a decade ago where I was spending a significant amount of time in the biblical Psalms, and over I was drawn to the phrase that the psalmist used: "The Lord is my fortress." I wanted to name my company Fortress Capital, but that was taken. So for me, ARX has special meaning because it's Latin for fortress, and we want to both be a fortress for our investors' investments. We want to be a fortress for our team members who help us drive value for our investors and our residents. And as we work on a daily basis, I'm reminded that what we have ultimately is not ours. You don't see any U-Hauls behind hearses, as far as I know.
That's true. So
we want to be mindful of an internal perspective as we go about our business.
No, I love it. That's awesome. And thanks for kind of clarifying that. That's great. How about your background? I'd love to always start really with your story, where you grew up and what eventually led you into this world of real estate investing.
Sure. Yeah, I could go back a ways. It's funny how when we're young, I think that experiences are so formative. I grew up in the 80s where we had the S&L crisis. And I didn't know these terms when I was a kid, but you just knew there was an economic dislocation. And I was in Texas and Oklahoma in the S&L crisis and the oil bust in the 80s. And as a result, we ended up moving around a lot as a family. We knew we were going to move states at one point, and the banks had taken back all these homes. This is in outside Oklahoma City. And so they put a program in place for renters because they found that the homes that they had taken back in foreclosure would sell better if they were lived in. And, they just kind of like a show home, right? And so my recollection is we had some kind of sweetheart deal living in these bank-owned homes as we were preparing to move to another state. Well, we were so good, and my mother was so good at keeping an attractive home that the homes kept selling that we were living in. And, it's in some fashion, it gave me a sense of kind of like the housing market and banks and lending and so on. And so we probably moved 4 times in 6 months or 7 months before we ended up moving to North Carolina, where I spent a fair bit of my childhood as well. But just that formative experience, as I look back, kind of exposed me to, let's say, the built environment. and the impact on people. And I mean, how important is it that you have a roof over your head in a safe community that you can afford? And
Yeah.
now you fast forward, a couple decades, and I end up in land acquisition with a home building company and become one of the partners at the firm as we grow that business, serving 55 and over customers throughout the East Coast and primarily Pennsylvania. And
Hmm.
it's providing affordable quality housing has really been a thread through my entire life, and working life that we take very seriously. And we wish it was easier in some ways to provide housing. But we live in a country and in states where you and I were talking, it's really hard to get the right to build things, which features into our investment thesis.
Yeah, yeah, for sure. And so, as you kind of, and that's interesting. The story with just kind of living in those homes and then having to move. And I had some friends that were actually doing that. For it was a really nice place to be. But they were like, "Yeah, I think the people came back twice for a second showing. I think we're going to be having to move here again."
Right.
So I've seen that firsthand. But yeah, that's neat to see, and I could see how that could kind of help give you a perspective of the markets and. But from there, when did you start like investing in real estate?
Sure. So, as a home builder in Pennsylvania, we were the primary investment capital, sponsor investment capital in a home building business. So that I would say that was my early investment, and it was certainly meaningful capital to invest that way, and different than what we're doing now because that was development and home building capital, and I learned. Unfortunately, I learned about phantom income investing in development and home building, and that's where you get the tax bill before you get the money, and you pay the taxes before you get the cash.
Yeah.
In 2016, I started buying mobile home parks, and I discovered that there's a reverse relationship to taxes and investment that existed I had not been exposed to because of the depreciation benefits tied to manufactured housing and land improvements. And so a decade ago, I would say I went all in on manufactured housing and RV parks, land rent for housing uses. And
Hmm.
we've been doing that here for the last decade.
Okay, no, that's fantastic. As we were talking ahead of the show, we do that ourselves, and so I'd love to hear about some of the areas that you're investing and kind of what you guys are looking for. But maybe starting with that first investment, when you got into and you decided to buy that first mobile home park, what about it did you like? And then kind of as that changed as you've continued investing.
Sure. So that's back up to 2016 and early 2017. I had capital and I had experience. My home building career, was fortunate to acquire. I don't know what the math is. $100 million worth of properties that produced $1 billion of home sales in my time there. And as I began looking at manufactured housing, um, I wanted to focus where I could earn compelling returns. And we continue to see this theme today where large institutional investors are driving values up, driving cap rates down.
Uh-huh.
And I was trying to go where they weren't. Let's say in 2016 and 2017. And for me, that meant I wanted diversification. So I wanted to be able to buy multiple mobile home parks, um, and I wanted to be able to get improved returns versus what I thought I could get buying larger, less diversified properties. And for me, that meant that I began looking at smaller properties, number one, and number
Uh-huh.
two, properties that had either one or both of the primary utilities, being water and wastewater, being a private utility. So that
Huh.
might be a well, or it might be a community wastewater treatment plant or septic system. And that was, just kicking things off. And remember when I had an aha, because I was kind of like, well, well water, and I didn't have a well personally. Like, I don't know about that. But something in me just said, well, hang on a second. Where does my public water come from?
Yeah. Yeah.
And then, well,
Exactly.
wait a second. Everybody's water comes from somewhere. And I started to really understand, like, where does my public water come from, and what I perceived as so much better, and where does well water come from? And I did a deep dive on that, pre-Claude, pre-Chat GPT.
Yeah.
What does it look like to have, quote, well water? And I got really comfortable with the quality of the water, frankly, the source of the water, and the thought that I could ensure actually the water was as good or better than what people who live on a public water system, think is, oh, somebody else, the government or the utilities taking care of it. It must be good. I
Right.
will get into my, questions about whether the government is using our capital well or not. Short story is that I bought my first mobile home park and it had well water, and I learned number one, in most states, if you have 15 customers or more connected to a single well, that becomes a quote public system under the state regs, and it's got to be
Right.
managed as such. And so, we went about the process of ensuring that the water quality was good, hiring a third party operator who was responsible for regular testing and submission of those test reports and so on. And we just, as a firm, while we don't always buy, private water systems, well systems, and so on today, we still look at those and we think about, can we deliver as good or better than a public utility? And it was funny a couple years ago, funny, not funny, one of those nor'easters blew through in the summer a couple years ago and blew out the reservoir where our public water system was.
Hmm.
And they were mailing out hundreds of thousands of boil water notices to the public customers. And of course, being in this business and having a number of private utilities, I was used to sending out boil water notices if you have something that you're fixing and you need to boil the water and you notify the residents. But the public customers they were irate. Well, what is this? What does this even mean? And it was like the
Right. Right.
first awareness that they had that their water, didn't come from some magic factory in the sky.
No, that's great. And that's interesting that your approach to that because a lot of folks and whether you go to some of the mobile home park trainings, and various things, you got the Frank and Daves and a lot of them say, hey, especially I mean for somebody new that's looking in to really try to focus on your city utilities, right? But I too have seen that there's a huge opportunity in some of the private ones. It seems like there's in some cases, you mentioned trying to stay away from where private equity was going, and the larger the deals that have the private utilities, sometimes people stay away from. So there's a little bit less competition.
Yeah, and
Um,
I thought there was actually a bigger gap that maybe was necessitated by the fact that you've got private versus public, which is, there's like the fear component, which I think we talked a little bit about. But the other thing is so many, quote, public systems in
uh-huh.
manufactured housing just mean the water is coming from a public place. It doesn't mean you don't have an obligation as a park property owner to maintain the lines in your community.
Yeah.
So then I was sort of like, oh, well, hang on a second. If I have public water and I have a leak in lines that I own on my side of the meter,
Yeah.
well, now I am paying through the nose for that leak. And
Oh
I
yeah.
better find that really fast versus, we're going to go try to find a leak in our private water system and we're going to find it, we're going to get it fixed. But we're not going to be paying through the nose for water usage that was going into the ground.
That's a very good point. That's a very good point. A timely point too. I just paid one of the water bills at one of our parks, and it just thought the same thing. I thought, geez, this is a lot larger than it was in March of last year, and so I wonder if we've got an issue somewhere. And I've got
Sure.
everything sub-metered, but like you said, if there's somewhere in between the sub-metering that there's a break or I'm losing, water somewhere, then it can be a pretty hefty expense for the park owner. So yeah, I love that. That's good. And what about on the packing plants, that side of things? Tell me a little bit about kind of your philosophy when it comes to that. I think the big danger, I guess, or the fear is that if one of these systems, and the well is the same way, if the well goes down, or you just have to make sure that you're prepared and have some capex that's set aside for those potential issues. And of course, when you're purchasing, you're going to be looking at that and hopefully mitigating that risk and that problem, upon the purchase, but would love to just hear what your philosophy is when it comes to the sewer systems as well.
Sure. I think we probably grade those systems kind of in using just the private wastewater treatment as a category. I would say within that, the subcategories are a wastewater treatment plant being the
Hmm.
most desirable, but hopefully the community is large enough to really support the ongoing maintenance and capital improvements to that. So like a 50 site community with a $1 million wastewater treatment plant isn't very exciting,
Right.
because if you end up with a big capex bill on that spread over so few units, it becomes a real burden to the landlord and to the residents. But we'd still say wastewater treatment plant would be number one. I think we'd say second would be septic, but I think there are kind of multiple types of septic. I think about two categories. One would be a community septic system, which I would
Uh-huh.
actually rank as like least desirable because it tends to take up, I think, some of the largest land area. You end up with, I think, a greater risk that you can overload that community septic system. Again, allowing for uniqueness of each property. So
Yeah.
I'd probably prefer a community where you had septics within the community, but where each home
Is
has
on its own.
it's on its own. And
Yeah.
sometimes, no more than two homes on one. Um, but ideally, you have each home on its own. And we find that, those septic systems, I mean, maybe you're pumping, if they're functioning properly, I mean, you're pumping 3 to 4 years.
Yeah.
And so you really are able to have a very manageable sewer cost for either the landlord or the residents, and how that's paid for. And if you need to repair it, right? Like a community system is going to cost, you may need to replace the whole system. It's going to be a factor of, 30, 40x versus taking care of just one single septic system.
Yeah. Yeah. Makes sense. Makes sense. Very cool.
We
And
would
so,
say, I'd say, Keith, I would say that if I had to choose between which one is public and private, water and sewer, I'd prefer private water and
Mhm.
public sewer.
Yeah. Okay. I could see that. It seems like that would make sense. And then so on your first mobile home park that you bought, what was the size of it? And then just tell me a little bit about the experience.
So, I come from a real estate background where I don't believe that anything in real estate manages itself.
Yeah.
And I think we all see these podcasts and we get the hits on LinkedIn. It's mailbox money or it's passive
Right.
income, and hopefully it can be passive for our investors, but hopefully the sponsor doesn't think it's
It's
passive.
passive. That's right.
We certainly don't have that perspective. And my perspective, and I think this is relevant. In home building, I was privileged to be part of a very successful home building company that not only survived the Great Recession but thrived through that. And I learned a ton about not over levering, but in operations about being boots on the ground. And so as a result, when I bought my first mobile home park, I really wanted to make sure it was something that I could visibly get to and be
Mhm.
participating in and ensure that we drove the value creation by being an on-site presence. And so we chose a property that was I guess it was about 90 minutes from where I lived, but it was also near where we had a second home. I thought, this is something that I can really manage closely, and
Mhm.
that proved to be the case. I think that's still we've grown as a company. We've expanded our investment horizon. It's been because we've been able to add team members so that we can continue to manage in a micromanagement way. Because when you buy value add properties, I mean, every missing a day, missing a week, missing a month in that process can be expensive for everybody.
Yeah. Yeah. For sure. And how big was the initial park that you
It was
purchased? How many
36
pad sites?
sites, and oh
Okay.
my gosh, 36 sites, and I think in early 2017, I think it was 1,000,003. Um,
Okay.
so I'm just doing the back of the napkin. That 36,000 a site. It's been a while since we saw a property at
For
36,000
that.
a site.
Yeah.
Lot rents were I think they were in like around 400, maybe low 400s. Um, and there were a few sites to fill, and boy, there were so many lessons. I mean, one example, Keith, is so we bought it from a park owner who he was retiring. This was the last one he was selling, and he owned one of the homes, and he was going to pay lot rent until he sold the home. And a decade ago, when he came to me a couple months after paying lot rent, he said, "I've got a buyer. You have the right to approve them." He said, "Oh, they're a good buyer. They're paying cash for the home." I think it was like 10 grand. And
Yeah.
I mean, truth be told, I don't think I did a credit check or anything else. I said, "Well,
Yeah.
cash for the home. I mean, guy must be good."
Yeah.
I've since learned that cash for the home, when it's a low priced home, is like a red flag.
Right.
And that guy proved to be kind of our worst payer over the course of our ownership of that property. We've since sold it. We sold it for more than double what we paid. Um, but I just remember, I mean, one time I went to the door to collect rent because he was behind again, and he opened the door and there was a hawk in his house.
Oh
Um,
my gosh.
I think he was kind of like a falconer. And he pulled out a bag of a Swedish fish bag, the red candies. Only it
Yeah.
wasn't Swedish fish; it was cash. And
Huh. Oh my gosh.
I'm like, oh my gosh, the story. I've often said, if I really wanted to make a lot of money in this business, we'd do a reality show
Right.
on
Exactly.
owning mobile home parks. But I prefer to not live in that public eye.
Wealthflow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. Yeah, exactly. But I do know what you mean. There are just some crazy stories that you come to hear about and learn, that just happen to happen within the park. So
Yeah, yeah, that was. So I think what did we learn there? I mean, we learned how important the background check and the credit underwriting is on our tenants. We are filling a number of sites. I mean, we filled over 100 sites with our homes in our communities last year. But something that we share with our investors that's often missed is, when we come in and turn around a community and are increasing rents, often people will choose to leave. Maybe it doesn't fit their budget, or maybe there's just a normal cycle. They're moving somewhere, someone passes away. um, we're successfully turning over 2 or 3x the number of homes that we're selling, right? So if we sold 100 new homes in our communities, we had resident to resident transactions of 250, 300 homes,
hmm,
where each one of those, maybe we bought the property and we didn't underwrite that tenant. We bought the property, we think they're good payers, but the truth is, we want to increase our credit quality, improve the tenant standards there. And so every time we get a chance to approve a new resident in a community, we're able to elevate the quality of the cash flow coming in from that property.
yeah. Yeah. And what about as far as just when you take on a park, are you looking for the opportunity for? I mean, I'm sure you're looking at how much can we increase the lot rent, but are you looking at for efficiencies like billing back utility, those kind of things? What all from a strategy standpoint are you looking for when you uh, underwrite a park?
Sure. I think we've decided we're not great buyers from institutions, either because they think they've done all the work and they're trying to drive the highest price, um, or they're maybe undereducated. I mean, sometimes you find these institutions who put capital in a deal and they kind of put lipstick on a pig, but when you really get under the hood, you see, oh my gosh, like there's significant deferred maintenance. You did a black tar and seal or something on the road, and you want me to think it's been repaved. And we're pretty
Yeah.
adept at finding those things. But in terms of like how what we're looking for in adding value, I think about a few categories. And frankly, rent raises should be kind of toward the bottom of how we're adding value. Doesn't mean they'll be the last thing we do. Often it's the first thing we do to help fund what needs to be done. But in terms of adding value, I'll say the easy but heavy dollar things are the utilities and the roads. Where are the problems with the sewer and water systems, whereby repairing them, we can hopefully reduce operating costs, but also improve the quality of home and community for the residents and the quality of life within the community. Um, the other big thing, which is also capital intensive, that frankly many people miss, is filling sites. I know that's one of those things that, well, I've got this. A lot of institutions and investors think initially, I've got these affordable homes. If I bring a home in, it's just going to fly off the shelf because it's so much less expensive than anything else that's available. Um, what we had to discover, and thankfully we did this a number of years ago, but many are just discovering, is actually the cost to fill a site. And in the Northeast, I mean, frankly, a fully loaded site setup can run you $35,000. And you've probably heard the same thing I've heard. Oh, it's $20,000. Oh, it's $15,000.
Yeah.
If you show me what you get for that, I'll probably find there's no driveway, no landscape package, no air conditioning, no shed, no commissions for your realtor who's selling it, and so on, right? So,
Yeah.
that fully loaded cost means you add a home on top of it, a break even, it's probably $85,000, $90,000 for a home in the Northeast, which is still a compelling value,
Yeah.
but you've got to budget that cost of filling the site. I can finance the home on our floor plan line as a dealer. Financing the site improvements generally is from equity. And I think that's, there are people who will get some leverage for that. We think that financing that through capital and accounting for it in our purchase is the most conservative way to do that.
Yeah, makes sense. No, that's a good point. So when you're looking at that, obviously you're seeing how many vacancies do we have as from a site standpoint, and just calculating that into whatever the offer is at the very beginning.
We are. Yeah, we want, one of the big questions is, can we sell homes for a profit, right? So sometimes we'll have to start out selling homes at a loss. So simple math, if my full package, home and set, is $90,000, and I can only sell homes for $70,000, I've got to book, $20,000 losses. Now we're going to hope that as we improve the community, what we're going to do is we're going to get to a break even and then hopefully above that, so that ideally, maybe on the whole, let's say we've got 20 sites to fill in a 100-site community. Hopefully over those 20, we end up break even. But that, the graph of profits tends to look like negative to positive, and, the midpoint is a break even. So that's what we're striving for. If we can end up really making money on the homes, then it becomes a question of how much velocity am I giving up to make money on the homes, right? Because in the land rent business, we want to prioritize filling sites where we begin to collect the site rent,
Right.
and put a lower priority on making money on the homes.
Yeah, makes sense. It really does. How about so you started out with the 36 site lot site, and then what about where are you now from your buy box? What are you looking for these days?
Well, today, I'll give you just a quick snapshot. So from 2016 through 2020, I personally bought about a dozen mobile home parks, about 1,500 sites. And in early 21, I contributed those to a fund. Effectively, I said, this is something, I've proven it out. I've built a team to support the management of these and to continue to grow. And I gave friends and family the chance to invest alongside my family in a fund structure. So that was March of 21. In late 24, October 24, through some selective sales and a big refinancing, we returned $21 million, which was over 100% of the capital. And I think we're at about 120% of capital return today in that first fund.
Very nice.
And we still own half of the properties in that fund. So I don't know, about 800 sites or something in that fund, which we're thrilled about. Our investors are thrilled about it. And right as we were doing that refinancing, we started our second fund. And that is a 4-property fund. But our first fund had about 50 sites per community on average. Our second fund has fewer communities. It's a similar capital size, but has about 120 sites on average per community. And love to say that we were just like really laser focused on that buy box. The truth is, we've been extremely disciplined about our purchasing. There was a whole stretch there from, late 21 to, late 23, early 24, where, you just couldn't buy. First, because institutions were throwing crazy numbers at sellers. And then second, when the rates started to increase, there was a massive disconnect between the numbers the institutions had been throwing out 6, 12
Yeah.
months earlier and the seller's expectation. So our second fund has been outstanding. We I can't say too much, but we think we're going to have a big event here in midsummer for our investors in our second fund, and so that's launched us into our third fund, which we're currently raising. And that buy box has shifted a little bit. We continue to operate and buy in the Northeast, primarily Pennsylvania, New Jersey, Maryland, and Delaware, but we're also expanding into the Midwest, particularly Ohio, Indiana, looking at Tennessee as strong candidates. And then we're adding to our acquisitions, we're adding seasonal RV. And the way I think about RV is it RV hotel or is it RV housing? And we're focused on RV housing, not RV hotel. So in
Okay.
RV housing, to me, you got a couple forms of seasonal stays where it's effectively a second home for a significant portion of the country who says, we're going to the lake this weekend. The lake's
Mhm.
open, the pool's open. That's where we're going to spend our time. And frequently you find that, generations of family and neighbors will spend time at the same place. We purchased a large RV park. That's a seasonal RV park with a wait list just 10 minutes south of Lake Erie in Geneva, Ohio. We're close
Nice.
to closing a deal in actually in Maine outside of Kennebunkport. It's another seasonal RV park. And the other part of RV is housing, is places in America where the economy is growing so fast that it can't produce enough housing. And so often RV parks become a source of long-term housing for contract workers and people who are part of that economic boom. Kansas City is a place where the world's on fire right now. If you don't know about Kansas City, I mean, it's really significant what's happening there. And I think affordability is driving it. So we think about RV as not this kind of like, third wheel vacation necessarily, but at the
Yeah.
core, it's got water, sewer, gas, some form of, electric, gas, heat. Maybe there's some amenities. It's a place for someone to live. And as you probably know, I mean, we're millions and millions of units short of housing in this country. And so we really like both manufactured housing and RV as housing.
Yeah. On that seasonal RV housing, so I like that strategy. I like the kind of it's a lot more of a long-term stay. Are you looking at leases then on those, or are they paying by the month? Or are they paying by the year? What does that look like?
Yeah, they're typically by the year. And so you do have
Yeah.
some positive cash float there where typically they're paying for the best deal, they're probably paying in November of the
Uh-huh.
preceding year. And then, maybe they pay through February and they bring their, bring their home in, or they open the site in the late spring, early summer. So you're fully paid, before they're allowed to step into their home for the
Yeah.
summer season. We like how that math works. And we also like that in our fund, as prices of manufactured housing have gone up, and we need to add value, which means the cash flow in the early years is lower. RV, we're able to buy generally at a higher cap rate and have higher early cash flow. So blending those two, still majority
Yeah. Yeah.
manufactured housing, but blending that with RV, we really like the cash flow that produces in the early life of the fund.
Yeah, that is nice. That is one thing that you can do with a fund structure that you just can't do with a single syndication. And so it's kind of the best of both worlds from that standpoint. And there's the diversification that
Yeah.
that you get just from having a variety of the two. So you're also a dealer. What when it comes to the mobile homes themselves? Tell me a little bit about what you typically, and maybe this is community specific, but what are you typically looking at when you provide a home there? Are you looking at a 3-2? Are you looking at a 2-2? What is your kind of go to? And is
Sure.
that different from site to site?
Yeah, it is different, is a short story. I mean, if I could and the community could support it, I'd do, multi-section. Yeah,
Hmm.
for our listeners, maybe double wide is the term they're familiar with. I'd do that on
Yeah.
every property. Um, the truth is not every property can support that, either financially, because it's just not a community where, I've got to get maybe $130,000 to break even on that home versus 90 on a
Right.
single. Um, or, and this is probably the bigger issue, is it just doesn't fit. And so, many of the properties that we're, able to purchase throughout the markets we're focused on have sites that are set up for single wide homes. So that often, if we can get a 3-2, we're probably going to do a 3-2.
Hmm.
We sometimes are doing 2-2s, even I mean, gosh, we've done 1-1s. So that for our listeners, one bedroom, one bath. And that's usually driven just by site constraints.
Yeah.
And
Just
I
not
wouldn't,
enough space. Yeah.
yeah, I really wouldn't want to do that. Most people want two bedrooms, even if it's just like a single person or an older couple, because they want that second bedroom for an office or something like that or guest. So we are really striving to do at least 2-2 and often 3-2s in our communities.
Okay. And kind of going back to some of the improvements, are there any? I'm just more curious for myself and hopefully the audience as well. But just curious on anything that you've done within the communities that has been a just something that the community itself has really, given you the feedback and said, "Wow, we really appreciate what you did here." I know just. In our experience, just even kind of redoing the parking area and putting stripes down and, where a prior owner didn't have it. That was a big deal. That was something I got a lot of feedback from. But I've thought about a lot of other potential options to make it more of a spot that the community can really embrace. And just would be curious to hear if there's anything that you've done that has
Sure.
really stuck out.
Well, I agree with what you're saying. I think often the biggest bang for your dollars in terms of resident appreciation is that early work on the roads.
Hmm.
And hopefully not just for appearances. Often we buy properties where the potholes are significant or the edges of the roads are falling apart. And it really, I think, um, they no one wants to pay more rent, right? But at the end of the day, I think they feel like they get some real value for that. And then we'll
Hmm.
often survey our communities, and after kind of initial pop of work here, and say, hey, is there a community amenity or something that you guys would really like to see? And it can be challenging to get quality responses to those, as you might imagine. But we've had
Yeah.
success with dog parks.
Hmm.
We've had success with kind of pavilion areas. Um, Both creating those and often redoing ones that are there. I mean, the number of times we bought a property and the playground had fallen into disrepair and wasn't safe, or you drive in and the basketball hoop asphalt is falling apart and the rim, has been ripped off. Um,
Right.
you know,
Yeah.
we want to come in and replace those things with high quality amenities that won't be so easily broken and give our residents the chance to experience that.
Yeah, for sure. Okay. And so what are you finding right now within the market? You mentioned kind of the time frame between 21, 23, 24 even. And are you seeing any relief when it comes to pricing and, kind of expansion of some of the cap rates upon purchase that just weren't there back in those days when it was, kind of the fever pitch of trying to get
Yeah.
a deal?
Yeah, we are. I would say that we are seeing an improved market. And I think, I think there's the actual improvement in the market, and the improvement, I think, is just, for the buyers for the sellers we want to buy from, the passage of time has been one of the biggest shifts in the market, right? Like
Yeah.
when they got some crazy number in 2022 from Blackstone or somebody backed by Blackstone, and that didn't close. And here we are, almost 4 years later, and they realize like, oh man, I got another year of, dealing with concerns the residents may have about the state of my community, dealing with maybe filling sites. And one of the things we see from mom and pop owners is they rely heavily on the cash flow from the property, and they don't have set asides for capital
Right.
improvements and maintenance. And so even just to bring a new home in, they don't have necessarily the financial backing, kind of the credit to get a home into the community or do the set with their cash flow. And so, they're looking at another year of maybe losing a resident or two, their cash flow
Hmm.
slowly diminishing, and losing value as part of that. And so the passage of time, I think, has been a good lesson. I mean, if you talked to me in 2023, probably would have said, we can never buy another property ever again. I just don't see how it could happen.
Yeah.
But the reality is, the folks we want to buy from have gone through life changes, either related to the property, maybe unrelated to the property. Maybe there was a divorce or a death. Maybe there's just estate planning that needs to happen. So that has brought more sellers to the fore. And in that period, we've continued to burnish our reputation as someone who closes, as a quality operator who takes good care of the communities that we're buying. I would say that's probably been the biggest shift in the market.
Yeah.
And together with that, kind of just a reality and awareness of where the financing markets are today. They understand you're going to borrow probably in the high fives, mid sixes, depending on where your debt's coming from. And there's no 3% money out there right now. And that,
Right.
they understand the translation to value for them.
Yeah. How about when you are purchasing? What kind of debt are you looking at when you purchase these communities?
We are typically looking at properties that either are agency ready or can
Hmm.
be agency ready.
Okay.
So that's going to be kind of the top financing for the listeners who are not familiar with it, where Fannie Mae and Freddie Mac are viewed, I think, as the kind of gold standard in credit for manufactured housing. And many people don't know, but this category has been their top performing loan category for many, many decades, I think 40, 50 years. So they continue to look at that, and it helps meet their duty to serve requirements as
Yeah.
an agency where they're providing capital that meets the need for affordable housing in the country. The second category is CMBS. So commercial mortgage-backed security markets have really, I think, come aggressively into this space post-COVID and really over the last few years. And it's not that it wasn't there before, but I think it felt a little more boutique, and the borrower had to pay for that feeling of being,
Boutiqueness. Yeah.
niche-y.
Yeah.
But today, I mean, Morgan Stanley, I think, did the vast majority of CMBS mobile home park deals over the last number of years. We have a large CMBS loan with them, and that market's continuing to grow. I'm told that these CMBS issuances, are all these loans from different type of properties packaged in. What they really want is they want to sprinkle in some manufactured housing into that CMBS portfolio to get the best value when they go to sell that book on Wall Street.
Yeah. Okay. Fantastic. Well, you're doing a great service for affordable housing, period, is a struggle. And just being able to provide that, I think, is something that, you should be proud of. You also mentioned kind of at the head of our conversation about kind of an over 55 community, that this may be more on the, single family side, but what are you seeing there? And is that something that you guys are still actively involved with?
Yeah, so my past life was almost exclusively new development of 55 and over communities, kind of like
Okay.
a mini villages style community. So,
Hmm.
200 to 300 plus homes with clubhouses and walking trails and pickleball and so on. And for that reason, I was focused and am focused on meeting the needs of that demographic. So we do own a number of manufactured home communities that are technically age restricted under the federal fair housing laws.
Okay.
We continue to like that. We think that super high credit quality and tenant quality in those communities. Often, if we're filling sites, they are cash buyers, and they're not the $10,000 home cash buyer. They're the $120,000 home cash buyer, where
Right.
they've
Yeah.
traded out of a single family home where they had, maybe no mortgage, and they're able to buy that home for cash in a no maintenance, or low maintenance community that we are owning and managing. So we like that. And I'm also, and this is kind of on the side of another investment category that I'm engaged with, which is developing, getting entitlements to build new housing and developing lots for national builders. And we do some 55 and over housing there. We really like that. We just like the characteristics. Because again, that's often a cash buyer. It's a buyer who, housing is less of a commodity. They're moving for lifestyle. And so that's more stable through economic cycles. They want, they need to move. They need to find that one floor living, whether the economy is good or whether it's not. And so we continue to like and invest in that space.
That's great. Well, Nathan, this has been a really interesting just hearing your story, and really appreciate you being a guest on the Wealth Flow. How can folks find more about ARC Capital and what you're doing?
I'd encourage them to go to our website, which is arcsventures.com, and then they can email me directly, nathan@arcsventures.com. We just love to get to know people and add them to our communication database so that if and when we have something that they may have the potential or possibility to invest, but more than that, I think on the front end, really help them get educated as they're thinking about making alternative investments.
Perfect. Two other questions for you that I ask every guest. One would just be any advice you would give somebody who's maybe just starting out in their investment journey?
Oh, boy. You're thinking about LPs in this instance?
It could be either one, but yeah, we can do LPs. Mm-hmm.
Yeah, I think for LPs, take your time. Get to know the sponsor that you're considering, sponsors you're considering investing in. We all are dealing with the crush of social media and AI and the noise of information. And frankly, it's easy to be duped by sexy marketing in those formats. And really take the time to get to know somebody. I think, frankly, I think I'm a little selfish. That benefits us. I think we'll stand up well to that test. But more than that, I want to protect people like my parents and my aunts and uncles and friends who are considering investments. And I know that, it's easy to get sucked into the sexy marketing loop on Instagram or Facebook.
Yeah, for sure. No, I think that's great advice. How about a book recommendation? Doesn't have to be real estate related, certainly can be. Just something you've read that's been impactful.
Yeah, you know what? You mentioned this before we got on the call, and I had a pile of books here. So this is Wendell Berry. It's a collection of essays and poems. It's called "What Are People For?" And for those of you who don't know, Wendell Berry is a Kentucky farmer and author who has written prolifically on culture and the impact we're making on the earth. And I just say I'm really impacted by his writing as we consider our impact on property. We own a small farm, Keith, and what we're doing there, where our food comes from, and frankly, Wendell Berry was writing 30 years ago about the impact of technology on the human soul, I think he'd say. And it's shocking to read how prescient he was 30 years ago writing about this, and it causes me to pause as I get off this call and click on my social media.
Right. All right, Nathan. Well, this has been fantastic. Really appreciate you being a guest on the Wealth Flow, and I think we'll call it a show.
Thanks for having me, Keith.
Yeah, thank you. All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love, more than anything else, to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.